Good morning, everyone. Welcome to this update for global stocks and commodities for the 25th of February. The headline is the correction is complete, and whilst we can never be certain about anything in the market completely, certainly the signs are looking very much that way at the moment. So I had a week off last week, as you know, and there wasn't a great deal happened in the market that was unusual. The rebound has probably been a little quicker than most people expected. And so in this update, I just want to have a look at why I believe the correction is finished, that we've seen the lows. I want to look at it from a couple of aspects. First of all, the fundamental reasons why the correction is finished, and in fact was really just a bit of a correction of an excess that had built up in January, and also more importantly how the next few months are likely to play out. And again, this is not making predictions, this is just assigning probabilities based on what the market is telling us right now and what human nature normally dictates in the way that markets operate. Of course, I'll be looking at just the normal stock and commodity trends, and there wasn't again a portfolio analyst last week, but the previous session covered really what to expect out of this correction in more detail than what occurs in these weekend videos, and how to prepare yourself for the next phase. So let's jump into it. The S&P ended up 15 points on the week, which was pretty good. 0.5%. It was a shortened week. The market went down initially for the first 3 days and then had quite a big turnaround on Friday, sufficient to put it in front for the week. So this has been really an excellent follow through from the reversal that we had 2 weeks ago from almost exactly the 200-day moving average. I think from here the overwhelming odds are that we'll get some sort of volatile trading range for the next few months. So nothing has changed from what I said 2 weeks ago. The only thing I think that is a little bit unexpected is just how significant this rebound has been, that it doesn't change the medium term, and it certainly doesn't change the long term at all. So I think a volatile trading range is the most likely outcome, and I'll try and put a bit more colour around that when I get to the charts. But first of all, I just want to touch fundamentally on why, and over the last 3 or 4 months, I've been week after week providing the fundamental backdrop, the global economic backdrop to what is underpinning markets. So I'm not going to go through that all again in detail. You know about that, the global synchronized growth, etc. But I just want to highlight a couple of big picture issues. And the first point that I want to make is that there is absolutely no reason for a bigger fall. Let's not overcomplicate things. It's about as simple as it is. There just isn't a reason for the market to do anything other than what it did, and that's just correct the parabolic move that we saw in January, which was unsustainable. So it's come back to trend, and that's really the end of the story. There's really no requirement for there to be any further falls in the market. On a big picture level, of course. That doesn't mean we can't get some short, sharp bits to the downside. In fact, I think that's probably likely, but we're only talking a matter of a few days or a week at the most. The second fundamental reason is that in the US, this has been the strongest season of companies beating their estimates since 2006. So anyone that thinks that this economic renaissance in America and the profit momentum that is built up in corporate America is struggling, then you need to think again, because it's been an amazing earnings season. We're getting the benefits of stronger sentiment. We're getting the benefits, whether you like him or not, of some of the things that Trump is doing economically, and some of the big payoffs have yet to happen. The spending on infrastructure, the tax cuts, etc. The other area that a lot of people are pointing at and have been for many, many years, they must be tired of running this line by now, and that is that the American market is grossly overvalued and therefore has to crash. It's actually rubbish. They're just using the statistics that support their argument. The stock market is a forward-looking animal, and therefore I believe in terms of valuing the stock market, you should only ever be looking at a forward PE for 2018. That's just the long and the short of it. And on the S&P at the moment, with this last little pullback, the S&P is trading on a forward PE of 16.9, which is equivalent to the 5-year average and is only about 1.5% higher than the 10-year average. So this is not a market that has a valuation problem, particularly when you've got the earnings momentum that we're seeing. The other area, of course, that has been highlighted is that people are now fearful with the Fed starting to raise interest rates, that inflation might rise more quickly than what they expected, and that would cause interest rates to go up more quickly. There is probably no question that inflation is on the rise, but we've got to keep this in perspective. There are some very powerful deflationary forces that have been around now for a decade and haven't changed, and they're going to limit the rate at which inflation can increase, and therefore the requirement for the Fed to put up rates. Those things include, this is hardly a definitive list, but these are some of the major ones. Just the powerful demographics around the aging population is going to have a significant effect on inflation, because there's going to tend to be less spending. The impact of technology, and I've talked about this many times, the impact of technology on making things more efficient, the requirement for less labour, and that has tended to follow through into fairly low wages growth. So with those very powerful deflationary forces still around and still likely to be around, it's really hard to see a sudden inflationary breakout that's going to cause a problem for the stock market. So that's it in a nutshell. As I said earlier, don't overcomplicate it. There's just no fundamental reason why the market can't consolidate around this level for a period of time and then probably advance to new highs sometime later this year. Now let's look at why technically. The 200-day moving average was not breached. We got a very significant reversal right off the 200-day moving average, and that's significant. Whether you understand the impact that technical factors have on the market or not, it's just a reality. Traders' behaviour is heavily influenced by whether prices are above or below the 200-day moving average, and this has been a very powerful rebound. Secondly, we've got leadership again from the Nasdaq, and the Nasdaq does tend to lead the market. If the Nasdaq is healthy, then the market tends to be healthy. And the Nasdaq is back in leadership again, as you'll see. And also the Russell 2000, reflecting the small cap end of the market, is also very solid. So the technical signs are really very good. Another one which is really important too is when there's a more protracted stock market sell-off, you normally get high yield junk bonds. So that's the bonds that should be trading at a much higher yield than they currently are. They would normally sell off. Now this time they didn't, and I think that's a telling factor as well. So that, I believe, reinforces that this was just a technical correction of the parabolic excess of January, because the guys that are active in the bond market are the professionals. There's so many amateurs in the stock market, and you want to look at what the professionals are doing at times like this. And the high yield junk bond market didn't sell off. They weren't concerned, and now we've got the stock market rebounding. Just on the US dollar, it's holding critical support at the moment. It's anything but convincing, as we'll see when we look at the chart, but it's still there at the moment. So let's jump in and have a look at some of the price charts. So this is the S&P on a monthly basis. So here in the middle is March 2009. So that's the bottom of the GFC. And you can see that this blue line is a 12 period moving average, so it's a 12-month or 1 year moving average, and you can see that the market declined to that level, but has already, so this is February, so has already rebounded very, very strongly. Yes, it's significantly overbought, and yes, this might signal the end of this particular run. In fact, it probably will. I now expect a period of consolidation because it's illogical to expect that this can just keep going up and up and up. So what I'm expecting is that we'll get a period that looks like this. Sorry, I'm just not grabbing this properly yet. No, I'll give up. I'll try again. I haven't got my normal laptop with me at the moment, so this is not necessarily going as smoothly as I would like. Okay, that's what I'm expecting for the next few months. Now, how long that is, whether it's 2 months, 3 months, 6 months, I don't know, and I don't intend to spend any time thinking about it. I just believe that we've had such a powerful period since 2016 that a sideways consolidation would be normal. And in 2016, that sideways consolidation after the first sell-off lasted for 1, 2, 3, 4, 5, 6 more months, and then we were off again. So I think that's the likely scenario. We get something like what we saw in 2016. But anyway, we'll take it day by day, week by week, and see how it plays out. Just turning to the S&P now on a daily basis, and this is the 200-day moving average there in red, and you can see the very, very powerful reversal that we had on the 9th of February, and it's just gone on with it. We got a slight pullback at the start of last week, and then Friday just completely covered all of that and added a bit as well. So that's our situation. Whether this goes up a little bit higher here and maybe has a challenge at the all-time highs around the 2870 mark, or whether we just get some choppy sideways action, I have no idea at this stage. All I know is that I believe that the correction is over. We've seen the lows. We're not quite sure where the range will establish itself. But I just know that if you focus on buying the dips in quality companies, that if your timing is not absolutely spot on, then you won't have to wait very long, and you'll probably be absolutely okay. And if you want to have a look at a chart, I'll just bring this chart up. See if I've got it here now. Let's take a look at Cisco, which is one of the world's biggest tech stocks. And I'll just show you how the really good companies behave during a correction. So this was Cisco. It had got up to $42 during the end of January. We had a very rapid decline down to around 38, which is not that much. And then you can see the extent of the rebound, gaps everywhere. And this has just been, one incredibly powerful rebound, and it's at new highs. It's higher now than it was at the end of January. So that's my point about buying quality companies when there's a dip in the price to oversold. It's an extremely high probability trade. Let's take a look now at the Nasdaq. So you can see we've bounced very hard, sorry, that's not the right one. Sorry, the Nasdaq just disappeared on me. Let me put that in again. Okay, so there's the Nasdaq. You can see very powerful rebound, also off its 200-day moving average. But what you'll notice about the Nasdaq is that it's much closer to its January highs than the S&P was. So there's definitely outperformance by the Nasdaq, and that's a positive sign. Let's look at the Russell. Looking very similar to the S&P, I must say. Had a little bit of a dip under the 200-day. You've got to expect that. Smaller cap stocks are always sold off more heavily on a percentage basis than what the larger stocks are. But look, it came out of that correction period pretty quickly, and it's regained about half of that slide in early February. So overall, the market in America is, I think, is looking fairly solid. I believe the overwhelming probability now is that we've seen the lows. I also would stick to what I said 2 weeks ago, and that is that I believe the chances of a new high in the next 3 months on the S&P are probably close to nil. I don't expect that to happen. I hope it doesn't happen, because the market really needs to consolidate. It's going too far too fast. So I hope the market doesn't form new highs in the next 3 months, but I fully expect it to in a period beyond that, and certainly well before the end of this year. Let's take a look at the US dollar index. We've got some key big picture levels here. You can see that clearly it's been in downtrend since the start of 2017, so a bit over a year. We've got some key levels, as you can see. There's one here where the market found support in 2015, again in 2016, and also in 2017. That support was broken, and we've now come down to this lower support level, and we're managing to hold it at the moment, but it's not looking particularly encouraging. And you can see if we break that, we've got a fair bit further to fall. I think at least we could probably be down around 84.5 on the US dollar index. And then, of course, we've got lows down here in the low 70s. Now, on the one hand, the fact that the Fed is raising rates and no one else is on the face of it, a reason for the US dollar to be stronger rather than weaker. But I believe what the market is telling us now, rightly or wrongly, is that they're concerned about the blowout in the US debt. The US deficit is already in nosebleed territory, and then on top of that, Trump is obviously going to be ramping up the level of spending and more government debt. And this is all occurring at a time when the Fed is trying to wind back their balance sheet. China is signaling they don't want to buy US bonds, or certainly not the quantity of US bonds. So the requirement for the US government to get funds in for the Treasury to issue debt is coming at the worst possible time. So I think that's what the market is reacting to. So we'll just have to wait and see how that plays out. All right, let's look at the Australian stocks. Our dollar is basically sideways over the last couple of weeks, just sitting between 78 and 79. Our index was a lot better last week, gained 96 points or 1.5%. So it was up about 3 times the rate of the S&P, and I haven't said that a great deal recently. But look, this was just a rebound from panic selling. It was a very deep correction that we had. There is no outlook, no change to the outlook in general terms. I'm still pretty disinterested in anything in the top 50 stocks. However, I am interested in 20 or 30 small to mid-cap stocks, which are outstanding niche players. And what we've seen through the Australian earnings season so far is that good earnings have been rewarded, and of course misses are being severely punished at the moment, as you would expect. There are opportunities, but they're much smaller in number. You can just about count them on one hand, and they're hard to find. You've got to be very patient. the situation in Australia compared to the US in terms of choice is just absolutely black and white. Let's take a quick look at the Australian market. So this is the ASX 200. So we dipped under the 200-day moving average, which wasn't really an uptrend anyway. It was just really going flat there for a period. And we've had a rebound from a very, very severe bout of selling. And I'll just look at the Australian dollar. So here's the Aussie dollar. We've moved up. We're still, we're in the top part of this range. You could argue that there's a slight uptrend happening with the Australian dollar, but it's going to be obviously heavily related to what happens in the US. Precious metals, gold rose to 1330, and there are some gold bugs out there that are getting excited by the action, or looking at the chart patterns and making comparisons with previous years, and look, who knows, maybe gold will move up to 1400 and break out. But from my perspective, on what we can see right now, there's no momentum, and precious metal stocks, which I believe are a better indicator of where the sector's going than the metal price itself, and they're not moving either. So for me, that tells the story. Let's just take a look quickly at the gold price chart. So this is gold on a daily basis, and we are still basically in the range we've been in for quite some time. And GDX, we're not getting any change in GDX either. There's GDX on a weekly basis, and we've been looking at this chart now since the start of 2017, so nearly 14 months, and you can see it's just gone nowhere. And until we start to see some momentum in gold stocks, I don't believe you'll see gold move either. Copper had a big dip during the correction, but it's back up to 320 now. Crude oil, sorry, was not down sharply. I hadn't amended that. My apologies. So I'll move on to the chart on oil. There's the spot copper chart. So we did have a dip during early February during the panic selling, but that's probably just leverage related. You know, people having to raise high leverage traders having to raise cash in other markets to cover losses in the probably particularly the inverse volatility trade. There's crude oil. So back up to 63.55. So we had a significant dip from 66, and we've recovered about 2/3 of that. So just to wrap it up, I believe the lows are almost certainly now in. The best stocks will turn far sooner than the index, which that's why I showed you that example with Cisco. That's not a recommendation. That's just an observation. The big quality stocks are going to recover. They're going to turn sooner, they're going to fall less, and they're going to set new highs sooner than the index will. And I believe in the near term, that's where your focus should be. As I cover in great detail in Portfolio Analyst, you don't need to do anything more than become skilled at reading the footprint of the big players. It's relatively straightforward to identify. It's a skill that takes quite some time to develop, because you've just got to go through thousands of different market scenarios over several years, and you've got to put in the hard yards. But the footprint of the big players is pretty straightforward to identify. Portfolio Analyst this week, I'm going to be looking at in detail at where the opportunities are, and of course there is a free trial there for you to take advantage of for a couple of weeks to see if you like Portfolio Analyst. But certainly the feedback I'm getting has been extremely encouraging. So my intention through Portfolio Analyst, as well as my other member services, is to make sure that you stay plugged in on when to buy and when to take profit in this market. So that's the rundown for this week. There's my contact details, and I'm sure it'll be another fascinating week. Cheers.